Hi, and welcome to the Rustandy Center's Perspectives on Impact Investing. I am the Impact Investor in Residence at the Rustandy Center and an adjunct assistant professor of strategy at Chicago Booth. And I also manage Impact Engine's private equity impact fund. And we're going to cover today really a history and overview of the current state and future state of the impact investing industry. Both in terms of the basics, in terms of what does it really mean to be an impact investor, what are examples of impact investments, but also careers in the field, how you get the proper training, what are certain trends, where do we think it's headed. I've broken up the presentation into two parts. The first one will cover the history and a little bit of a landscape overview, and the second will speak more specifically about real impact strategy examples, both at the fund level as well as the company level, as well as careers in the field. So first, by way of background, I want to share a little bit about my career history and what brought me to this point, because I think it's illustrative of what a lot of people, how a lot of people find themselves in this industry. So I started out right out of college being really interested in using my background in business and as an entrepreneur to affect social good in the world. I did a year-long history project or independent study with a history professor looking at the history of social movements, the role corporations played. And it was actually through that I saw the role of investors and how powerful they are in actually influencing corporate behavior, in addition to the pillars of government as well as consumers and what they demand of their companies. But I was really interested in the role investors play. And so I went to KLD, Research and Analytics, down here, number 1, which was the very first ESG ratings provider. We did research, social and environmental research on public companies, and sold it to financial advisors to build portfolios of socially responsible investment companies. And my role there specifically was actually to help take this research and mainstream it, sell it to mainstream asset managers. And amongst them, we licensed our index to iShares to create the first ESG ETF at that firm, and a number of other banks, which led me to number 2 Northern Trust in Chicago, which many of you may know is a mainstream, not an impact investment firm, not like KLD, did not have this commitment from the beginning of the firm. But I saw an opportunity there driven by client demand to create ESG products for their clients to invest in. And so I developed the business plan for them to offer ESG funds and other products and went about doing that. So you can see the impact intent is less, and it's kind of in the middle because of my role and what I was doing there. But the financial intent was there to provide the same type of financial returns and outcomes as anything else the firm was offering. I then went to Aurora Investment Management, which was a pretty large and well-known fund of hedge funds. We built portfolios of hedge funds for institutional clients. And I went there because I wanted to get the financial skills to really invest for good. And I recognized that a lot of folks in the ESG and impact investment industry didn't have that. So Aurora itself had no impact strategy or mandate. It was purely financial. But I, along with a lot of people in this field, do sometimes take a portion of their career to really focus on developing the hard technical skills, which is very important, in order to do that with impact. Which brings me to number 4, the Schwartz family office. This is a large single family office where, again, the firm as a whole, it's not an impact investment firm, it's not an impact family office, but there were certain pools of capital and certain clients and family members where I was developing impact investment strategies, and they are also fairly engaged in philanthropy. And then finally, I'm at Impact Engine now, where our firm, everything we do is focused on generating strong financial returns, so it's high up on the y-axis, as well as really intentional, measurable social impact, all the way down on the x-axis. And so it sometimes takes a few points in your career to develop the full skill set to be able to do both of these really, really well. And so that brings us to the question of what exactly is impact investing then? And what you see here are 2 definitions that intersect in a few ways, and these are common definitions. One is you see the word intention or intentionality bolded, meaning the investor has to be trying to create social impact. It cannot be accidental. And that's because their investment strategy and process, all the way from the way they source to how they manage their investments and exit them, should have that impact intentionality. The second thing is this focus on measurable impact as well as a financial return. But what you don't see in either of these definitions is any specificity around how much. And that's because impact investing can be something that is targeting the same or greater financial return for something that has no impact intentionality involved, or sometimes it intentionally is targeting a lower return, which some people refer to as concessionary returns or catalytic investments, because they believe that by lowering the financial bar, you can actually generate a certain type of impact that otherwise investors wouldn't be able to invest in. We'll talk more about that throughout the presentation. Now, a lot of people have the question of, is impact investing ESG investing? And so I put up a couple of definitions here for you to see around ESG. Again, people will talk about it differently, but I think the core definition that you see here is that there's a really, the intentionality here is not to generate a certain social impact outcome like impact investors, but an intentionality to, fully, systematically, in an integrated way, assess the environmental, social, and governance factors or influences over a portfolio and a company that may result in potential risk, greater risk or less risk based on how it's managed, as well as opportunity. And so ESG investors are committing to considering this and doing a good job assessing it, but it leaves out the explicit goal of generating a particular type of outcome. These two can be managed, together. I would say most impact funds have some ESG component as well, but most ESG funds don't have an impact component. And that's an important thing to know. And so across the spectrum, as I mentioned, you could be targeting specific outcomes, but also avoiding exposures, which was really the beginning of where this movement started, of exclusionary screens, or saying we're not going to invest in certain industries because we don't believe that they're contributing something positive to society, or more explicitly, maybe they're contributing something negative. And ESG integration in the middle is really the full integration of all of these effects. And if you look at the history of it, as I mentioned, it really got started, actually well before the 90s, really with a group of religious investors initially, the Quakers and Catholic investors as well, saying we don't want our portfolios to be misaligned with our values and our mission. And so they had these exclusionary screens. And that led into a wave of divestment movements, beginning with apartheid in South Africa, and a group of investors led by religious investors actually saying, we're going to divest or no longer invest in companies doing business in South Africa to try to influence those corporations to move their operations out. And it actually had a very meaningful impact on the end of apartheid. That was one of the things I studied back in college that led me to believe there's some real efficacy to this type of investing. It was really in the early 2000s that we saw assets start to grow. And that was right around the time that I mentioned at KLD, I was helping to sell our research and indices to mainstream firms, where this was no longer just for values aligned or mission aligned investors, but really the idea that all investors, whether it's individuals or institutions, should be considering this because it actually has some financial materiality. And what came after the broader adoption of and mainstreaming of ESG is this idea of impact investing, where investors are targeting a specific outcome. In many ways, I think this portion of the field came out of a dissatisfaction with ESG. Hey, the assets are growing and people are doing this, but what is the outcome? Is it really leading to any difference in the portfolios or the corporations? And so investors started to say, we want to target those outcomes. And the word impact investing was coined in 2007 with that idea. And so the Industry Association, the Global Impact Investing Network, started measuring the assets in this field in 2013. And you can see that it's grown quite a bit, but it still dwarfs or is dwarfed by the assets in ESG. Today, if we segment or treat this whole space as one big tent and look at the different strategies with them, again, sometimes they're overlapping. These don't have to be mutually exclusive. We still see the most assets in exclusionary or negative screens, followed by ESG integration, shareholder engagement, thematic screening of portfolios, and finally, impact investing, very small. Yet if you look at the growth rates, the CAGR over the last few years, the growth is really coming from the more intentional impact investing and screening, as well as ESG integration. I personally believe that all investment firms, at least those that are well managed, are going to have a highly sophisticated approach to ESG integration across the board. It's just going to become business as usual for the investment industry. And so I think we'll continue to see that fast pace, but impact investing, I think, will always be a subset. So I want to frame this in the context of the broader investment industry, which is that it's really a bifurcating market. We see huge gains year after year in passive investing, index investing, because of the low fees. The data has shown that beta is really driving returns over the last market cycle and even before that, as well as highly differentiated strategies, venture and private equity, private credit, gaining a lot of share. And the strategies that are somewhat differentiated, like active management, they're not in like the value creation of the manager is sometimes questioned, but it's not purely indexing. They're losing market share. At the same time, we're seeing boutique firms, which are highly differentiated, have a particular domain expertise in a sector, in a geography, in a particular strategy, gaining share, as well as giant asset managers also gaining assets because they offer certain advantages for large institutional investors as well. And it's the medium-sized firms which really struggle for relevance because what they're doing is not necessarily differentiated. And so this is where I think, that along with some of these other trends here in terms of investors having greater demand for customized strategies and transparency, fee compression, technology disruption, and just the enormous transfer of wealth to women and millennials who are really showing that they invest with their values more and more. This is all in favor of and really great tailwinds for the impact investing industry, which really responds to this in terms of who the investor is, what motivates them, what they're expecting of investment firms in terms of their customization and their outcomes, and that fact that impact investment firms by nature are highly differentiated and focused and bring a certain domain expertise that mainstream investment firms don't necessarily have. So now I'm going to go a little bit more deep into what really counts as impact, because I hear a lot of folks frustrated by the field in terms of, we see some investment firms defining impact this way and their portfolios look like this, and someone else totally negates that. And what they consider impact investing is completely different, and their portfolios look nothing like that. Or quite frankly, their portfolios look just like non-impact funds. So what really is the difference? So let's try to dissect that a little bit. The first thing to acknowledge is that it still is up to the investor. Impact is in the eyes of the beholder. And that is why the asset management industry has taken so long to respond to this demand. Because if every investor decides on their own, then it requires customization. And this is an industry that's predicated on scale. So it's been difficult. And where there have been overlaps in terms of mission and certain values, they create their products. But otherwise, a lot of investors are really left hanging. What's really changed is the development and the acceptance of the UN Sustainable Development Goals, which are 17 social and environmental and governance issues that everyone can agree are universal problems worth solving. That if we devote capital and if companies are developing products and solutions and services to solve for these, we will all benefit. And that consensus and investing into what are shared societal problems and needs makes it easier for the asset management industry to respond. It's still very high level, and we find that certain investors and firms may focus on one of the SDGs or several of the SDGs, which we'll talk about. And at the same time, if you peel the onion back in any of these, you'll realize that there's still a lot of subjectiveness to each one. What is quality education? For whom? Et cetera. And so Impact Engine and what I've really personally also subscribed to is just a really nice, simple model for starting to peel the onion back and really assess impact is what we call the 5P framework. And the 5 Ps describe 5 core levers any business has to drive impact if they so wish. It helps us evaluate and understand where the company could be driving impact and whether they're doing it. underlying all this is the same principles we talked about in the beginning around intentionality and measurement. But just to give you a few examples, place-based impact investment is focused on companies where they are intentionally choosing to locate their operations or headquarters in a particular geography in order to create a certain type of impact. That could be emerging markets at large. It could be opportunity zones. It could be urban areas or rural areas for that matter. But it follows not just the desire to do it, but an actual business strategy to create impact in that particular geography. So L&J is an example of a company based in Liberia, intentionally based there. They are a fashion and apparel manufacturing company in the denim space. And they chose that location because that's a country which, statistically has shown low enrollment for children in education in schools. And at the same time, low employment of women. And L&J, created their manufacturing facility there and explicitly has hired women and has shown that, by employing women and making women the income earners in the families and also the decision makers, a much higher incidence rate and enrollment rate for the children of those women who are their employees versus the broader country. People-based impact is closely related to place because there is, correlation and intersection in terms of locations that are under-resourced as well as the people and communities there. And so this is the intention to specifically employ or the owners of a business to, again, strategically leverage and better resource certain populations. So Maven, some of you may be familiar with, is a line of hairstyling products, and it's specifically sold by stylists who otherwise are not typically getting commission from the products that they're selling. And so this gives them the benefit of economic empowerment and additional income from selling products themselves. Process-based impact is the one that I would say is most closely aligned to the broader philosophy and principles of ESG investing, and that it has to do with how a business conducts itself. If we look at their supply chain practices, their HR and employee engagement practices, and everything in between, it's companies who are really, again, what's different from ESG is there's this intentionality around, we're going to manage this in a certain way to create a certain outcome. So Patagonia, for example, the clothing itself, is not, I would say that's not the biggest impact, but it's the way they make it. They're focused on sustainability of the raw materials for their products, as well as their highly engaged employee base. And I would say taking it even a notch further in terms of their environmental campaigns and support of environmental policy. All of that has built a company that is trying to create a certain environmental impact through the clothing that they sell. Product impact focuses on one step deeper than Patagonia in terms of the actual design of the product and what they're selling is specifically driving a certain outcome. So D-Light is a solar LED lighting company specifically sold in emerging markets where it's very common to have blackouts and brownouts and you don't have access to lighting. So for every solar lamp they sell, every widget and product-based impact company sells, they're driving more impact. Of course, we want them to be managing their process and ESG and business practice as well too, but the intentionality is around, we actually created this product to create this impact. And finally, paradigm is really businesses that are created, structured, selling, owned in a way that's completely disrupting a paradigm. Coursera put prestigious higher education online for free and fundamentally disrupted our education system. At Impact Engine, we're also starting to make investments in employee-owned firms. And this falls under paradigm-based impact, which is saying if we structurally change who owns the company, we can structurally address wealth equality in our country. That's not dependent on certain, tax policy shifts. When you're evaluating impact in a company or evaluating a fund which is telling you they're creating a certain type of impact, you can, again, start to assess it a bit further by asking questions like you see on the right, which the Impact Management Project has put together, these 5 dimensions. What type of impact for whom, how much, what's that specific business or enterprise or investor's contribution to it, which is sometimes called additionality, and risk. What's the social risk? Investors look at financial risk, they should look at the social risk. When you ask these questions, it leads you to naturally start to develop a thesis or a hypothesis around what is the problem, what is the solution, and why you think this company or this investment will help solve for that. And what you see on the left here is what's commonly referred to as a logic model or a theory of change, which begins with thinking of the inputs. What is the company or the investor putting into the enterprise? What are the activities that they do with that? What are the outputs that come from that? What are the outcomes in terms of the real social or environmental impact? And what's the broader impact on society or communities or the larger system? These can each be measured. And as we talk about measurement next, you'll see that at the end of the day, we want to be measuring impact, but there is, it's not always achievable and practical to do. Both because of the time horizon in which you're an investor. By the time you see the additionality or the impact, the holy grail here, you may not be an investor. And so if you're measuring to create the impact or measuring even to decide whether there will be impact, right? To make the decision, how can you do that if it hasn't been done yet? And there haven't been randomized control trials, for example. And so what is more common, and I think a best practice for a lot of firms, which are really committed to this, is to focus on those outputs and sometimes outcomes, if it's achievable, to validate that final impact or additionality that's in your thesis. And so there should, it takes some real analysis of this, and you need some proof points or evidence or reason to believe that the outputs will create the outcomes, which will create the additionality. But measuring outputs is just much more achievable and practical for investors and companies. I also want to say that the industry often faces a lot of scrutiny around the lack of standardization of impact measurement. Some firms are doing it this way and some firms are doing it that way. That is true, and it's a real opportunity for anyone looking to get in the field to do it right, to potentially even build your own firm, which helps establish this. And at the same time, it's not true, in that sometimes people are just talking about different things. So for example, there are ratings providers like Gears or MSCI and Sustainalytics for public companies, which are providing ratings like an A, B, C, D, or a gold, silver, bronze. And that's across a portfolio. And it's really trying to, in some ways, by standardizing and boiling it down to a rating, they're not really focused on that impact outcome at all. They're just more rating the business practices. And it's a totally valid thing to do, but I wouldn't call that impact measurement, as we've been talking about. That's ratings. And there is some standardization there. On the other hand, a lot of folks are focusing on the SDGs. There's a lot of consensus. There's standardization around the use of SDGs, but that is also not measurement. That is goals and targets. You can measure the amount of dollars that are going to the SDGs, but it's not actually explicitly a measurement tool. In the middle, we have the Impact Management Project, as I mentioned, which is a framework that there is buy-in, there is standardization. People agree. This is a good framework that a lot of people are using to be able to develop an impact thesis, which then does help you develop the metrics and measurement. And there, I have Iris Plus listed, which is a great tool you can look up online yourself. But I would say that even Iris Plus, which is a standard system, it's all customized. It's bespoke per company. Because a company whose outputs and outcomes have to do with the reduction of greenhouse gases has a totally different KPI or metric than a company that's focused on educational outcomes. And so what we need is not standardization around one measure. It's not something you can unitize and aggregate like that. It's not an IRR. It's standardization around how you measure impact and what you do. And there are standards like the IFC and PRI and others, which are helping to create the standardization around here is what it means to be an impact investor in terms of establishing goals and targets, having metrics for each investment, using frameworks to develop those metrics. And here are ratings to rate your entire portfolio. So there's a lot of room for improvement. And I really view that as an opportunity, but the field's also already doing quite a bit. The other question folks always ask is about return expectations. We touched on this a little bit in the beginning. Does being an impact investor cost you something? Or does it make you something extra? Is there a certain risk involved? And I will say, as you can see on this matrix on the left here, it's yes to all of it. It depends what your objective is. And again, step back. That's actually true for all financial investments. This idea of risk return, it's, by the way, not always linear. Sometimes, you're getting greater reward for the risk you're taking. And sometimes you're taking more risk than the reward you're getting, not necessarily intentionally, but because there's something called, luck and skill. This is not it's not always predictable. And also, investors have different portfolio needs. Some investors have certain liquidity needs. They have certain tax needs. They have certain concentration limits, diversification needs. And sometimes that results in them targeting a lower return to achieve that. And I think of impact as just another dimension of that. It's one more thing. And so when you're intentional about assessing it and managing it, you can go in eyes wide open to say, we think we're taking this added risk, or it's actually reducing our risk, or we think it's actually going to drive better returns because that product-based impact leads to a competitive advantage that their competitors aren't capturing in their product market fit. And so I would argue in the upper left quadrant, ESG investments, again, without some specific end impact goal, it's just better investing because they're looking at more data points and better understanding companies than folks who are just saying, I'm not going to pay attention to ESG. Why would you ever do that? It's not even rational. But within the right quadrant, I would say that there are firms which are plotted right on that diagonal line, which are saying, generally we're targeting the same. And there are companies, there are funds which are more financial first, saying, look, we're targeting these returns and we're considering impact. And, we don't have like a necessarily a bar or a certain standard or an impact. We just want it to be positive, world positive. One investor uses, for example, that terminology. And others are saying we're impact first. We need to have these outcomes in our portfolio. This is what we're promising. And we will generate a certain return. Maybe it's 10%, 15%, a 2x return, a 1.5 return, whatever it is. But it's more like they're optimizing for that minimum or approximate return and maximizing the impact, right? Versus maximizing the return, the financial return, and optimizing for the impact. And this is the nuance and subtlety that I think people miss. And when you really drill down to the examples, which we will, you'll start to see this come out. The other thing I want to say around ESG is, as I mentioned, I think it just makes you a better investor. The ESG field has a much longer history. It's a lot of it's grounded in public markets data. And so the data sets are longer and deeper. And, most of the academic research you will see actually points to some type of advantage, material advantage to companies that really manage their ESG factors, which is, again, why more and more investors, all investors are taking this into account. And finally, before we head into the next part, this study was done by Impact Capital Managers, which is an association of market rate impact funds that are targeting the same or similar financial returns as other private equity and venture funds. And we looked at all the firms in the network, which includes Impact Engine. We participated to really look at our portfolios and try to articulate and model what actually is it about being an impact investor that can lead to alpha or superior returns. And so you see these three categories here in terms of being able to access opportunities because of our impact angle and resources, being able to create a certain type of value that other firms can't, or being able to strengthen those outcomes. And on the right, how these actually translate into a source of financial value. So can it be done? Yes, but it needs to be intentional. It's not the idea or the aspiration of impact alone. You have to have a real strategy behind it that's concrete, and you have to manage it. And if you're going to manage something well, you need to measure it well too. So that is where we will pause right here before we go into focusing more specifically on investment strategies for impact investing. Welcome back to the second part of Perspectives on Impact Investing. We just covered kind of the history of impact investing, the definition of it, a little bit on how companies can actually drive impact. And now we are going to focus more specifically on what this looks like in different asset classes, as well as for different underlying investors and asset owners. So let's start off with just a market update in terms of literally where is it by dollar amount. So you'll see that if we look at allocation for ESG, the broader umbrella, right? It's a lot of public equities and public fixed income. And that is for two reasons. One, those are much bigger markets and much bigger allocations for investors. You could think of the standard 60-40 asset allocation portfolio from public equity to fixed income. But if you look at endowments and institutions, which incorporate private equity and alts and all that, still a lot of them are more than 50% public markets. The second is because ESG investing, which as I mentioned has a much longer history, is actually something that can be integrated across all portfolios, not just those with an impact thesis or goal. That's further along, and so you see that more expressed in public markets portfolios as well. Now, when you look specifically at impact investing, so the intention to generate this type of impact, you see the much greater share coming from private equity and private debt, as well as real assets. Interestingly, we're starting to see public equity and public debt take a greater share. Now, this is a really important point because I think a lot of people assume impact investing means private markets and ESG investing means public markets. So not true. But it is true that impact investing has really started out in private markets. And part of that is, as you'll see when we go through the examples here, is that, when you're an investor in a private company, you tend to be more engaged with the company. Public investors, a large investor might be a couple percentage points. Typically in private markets, you have investors which are controlling investors, or they own 5, 10, 15% of the company. And so they're more engaged, they're expected to be. And so there's a greater opportunity to create that type of impact through the investor's role as well. But increasingly, I think there's almost like a renaissance of ESG investing that's going on in public markets, where you're seeing greater focus again now, are people turning towards shareholder engagement and activism, which, if you remember from part one, that's actually how this all started with the shareholder activist campaigns. And I'm seeing that come back, which is, I think, really, really encouraging and an opportunity for public markets impact strategies to really garner a greater allocation. So what does this actually look like? We've talked about a little bit of this, so I won't be redundant, but let me remind you. So in public equities, as we mentioned, it's screening, it's thematic portfolios, increasingly active proxy voting and taking on activist campaigns. In venture capital, these are early stage startups. It's the opposite of public equities. And investors are really looking for companies and founders which have some type of impact intention there from the beginning, and it's expressed in terms of how they're building their product or who they're employing, where they're doing it, back to the 5 Ps. Definitely high risk, high return, and a small portion of allocations, again, just as reference, not impact investing, just general allocations. Now, private equity is kind of in between. These are established companies. They typically are EBITDA positive. They could be from 10 million to $1 billion in revenue. Investors can be control oriented or funding growth, and they still have quite a bit of influence. Greater portion of investors' allocations typically because of the lower risk and similar return profile. Public debt and fixed income securities, it looks a little bit like public equities in terms of exclusionary screens, integration, and thematic portfolios. What is an extra twist here is social impact bonds, or pay for performance type bonds, which is essentially funding for certain projects that investors will invest into, whether it's early childhood education or reducing recidivism out of prisons. Essentially, the interest rate is tied to the social impact. So that's a whole other field. Don't have the time to go into depth about that here, but that's a whole other strategy within this field. Now, private debt is lending specifically in private terms, so these are structured to corporations, to real asset projects like real estate or natural resources. Can be consumer loans, especially finance companies or project finance related to infrastructure. So this is actually, there's a long history of impact investors in this field, from CDFIs, which are community development financial institutions, just lending to small businesses, SBIC loans. And it's also an asset class that is growing quite a bit in interest. Again, aside from impact, just the attributes of being able to provide a certain type of return in a low yield environment in public markets to get a greater yield oftentimes lower risk than venture capital or private equity. And finally, in real estate, impact investment strategies can have to do with targeting certain types of assets, whether it's affordable housing or sustainable ag. It can also have to do with turning them around and improving them. So maybe buying a commercial real estate and converting them into LEED certified buildings, for example. So let's walk through some of the examples. Specifically, we're gonna just target a few of these that are the greatest area of attention right now. So venture capital. These are three firms here. Rethink Education, per the name, focuses explicitly on education outcomes. They are product-based impact investors, and so they're typically focusing on ed tech companies that are grounded in rigorous pedagogy and scale and focused on making education accessible to folks too. So Upswing is an example of a company that really provides a lot of wraparound services and 24/7 support, tutoring, et cetera, for higher at risk students in education systems and helping them achieve those outcomes with graduation rates of success. At Impact Engine, we are product-based impact investors like Rethink, except our focus is broader than education. It's also health, economic empowerment, and sustainability. Our venture strategy here focuses on tech companies, and we tend to bring a pretty heavy focus on companies that are providing greater accessibility or gap narrowing in terms of who's getting access to education, health, economic empowerment, for example. And Regroup is an example of a company we invested in their seed round right when they were starting, have continued to invest. They're now a much larger company. They merged with another company, and they're entirely focused on telemental health. Our original thesis was around focused on the fact that literally 50% of the counties in the US don't have a single mental health professional. So even though, Post-Affordable Care Act being passed, more and more payers will pay for mental health services. If you don't have someone you can access, it doesn't matter. So our thesis was that technology could solve that gap. And Regroup was providing exactly that, mental health services for those 50% of counties which don't have it. Increasingly in COVID, especially, we're seeing that this is just a convenience thing. There can be people in the Hamptons who want to do therapy on their phone, but Regroup specifically focuses on those zip codes which don't have access. So rural areas, prisons, Native American reservations, 70% of their underlying patients live in zip codes with no mental health professionals. And Quona Capital, they are also product-based impact investors, but they're focused on a certain place-based as well. So they're investing specifically in emerging markets and focus on financial inclusion. Klar is a digital bank and company, a neobank in Mexico, and pretty fast-growing company. You can look them up, and that's kind of core to Quona's thesis around financial services companies in these emerging economies who are actively serving the bottom of the pyramid as well. So in private equities, I mentioned these companies tend to be more established. TPG Rise, the Rise Fund on the left, has been an important player in this field in that they were the first, or one of the first really large private equity funds, TPG, to come out with an explicit separate impact fund called the Rise Fund. It was $1 billion fund initially and has since grown even beyond that. So they're investing in companies that are a bit more growth stage. They're a bit wider in their definition of impact. They include product, place, process, and their definition is even businesses that are changing our world. So that can mean a lot of different things. They get some scrutiny in the field around what that means, and have a lot of really great investments too, like Zipline, which is a drone company that provides supplies in natural resource disasters, for example, and so there's a health thesis around there and access as well. Closed Loop Partners is an investment firm focused exclusively on the circular economy. and they serve a lot of corporates who are looking to advance their practice in this space. And so that's where a lot of their investment dollars come in. They have a lending strategy, they have a private equity strategy, a venture strategy, but it's all focused on the circular economy. So Balcones Resources, for example, is essentially it is a waste management company, but they focus on recycling and with even more intentionality, so they can work with customers like Unilever, which is owned 7th generation, for example, and really understand what are their needs around product packaging that comes from recycled materials, and being able to source and create that for them in order to create that packaging. And Leapfrog finally is a mix of product, people, and place-based impact investing in private equity. They are focused on in the emerging markets as well, specifically Asia and Africa, and focus again on serving the bottom of the pyramid and the emerging consumer class around healthcare and financial services, which for a lot of folks in these countries, this is not accessible to them yet. They can't afford insurance or financial services. So All Life is an example of an insurance company in Africa that focuses on insuring everyone, all life, providing life insurance for those that maybe typical insurers wouldn't provide. And so they have a different underwriting methodology. Private debt, as I mentioned, you can be lending to companies or people, and the impact can come from both what you're investing in, but also how you're interacting with and influencing the companies as well. So similar to private equity, except you're not an equity owner, but you're using your stick and carrot as you have covenants, right? And you can build and impact covenants, as well as just kind of focused on partnering with management teams on certain initiatives. So HCAP Partners is an interesting example. It's not product-based impact. Their companies include Diamond Contract Services, which focuses on janitorial service company, right? There's nothing impactful about that explicitly. But when they lend to companies like Diamond, they lend with a specific agreement in place, which is that the company, they're going to help them really adopt best practices around HR and employee engagement. So things that many of us take for granted around PTO, right? Or parental leave policies, 401ks, et cetera. And so they kind of say, hey, we're going to invest. We're expecting you to have certain HR practices of firms that are have targeted this more intentionally, as well as focusing on other ESG management issues. Calver has been a real leader in this field. They have a bunch of different strategies, but specifically here, they have a whole strategy around providing community investment notes in small businesses. And so Garfield Produce, for example, on the west side of Chicago, is focused. It's a local, vegetable farm, employees from the Garfield Park neighborhood, many of them formerly incarcerated, and they're really providing the loans like CDFIs do, et cetera, and certain tax credits in order for them to be able to run their business. And so the impact is those people in that place, product based on the farming as well, but the people in place really. And Root Capital finally is interesting in that there's a systemic kind of impact, paradigm-based impact investing that's going on here too that you could add, and that a lot of small farmers in emerging markets, particularly South America, where they tend to focus, they might be providing cotton, for the textile industry, or coffee beans for the coffee industry. And these smallholder farms, oftentimes, they don't have the working capital in order to run their farm before they get the big order from Starbucks. And so Root Capital actually provides debt capital to serve as working capital to bridge that, so that these smaller landowners and farmers can actually sell to and be part of bigger companies buying from them and participate, instead of just large industrialized farms benefiting from that kind of demand. In public markets, as I mentioned, impact investing takes a certain kind of intentionality that goes beyond ESG, and you'll see a spectrum here. So Parnassus was actually, I believe they were the very first SRI, social responsible investing, or exclusionary screened investing fund, mutual fund out there. And they invest in good businesses with attractive valuations while taking ESG into account. So maybe none of these companies stand out to you as an impact investment. Their product is not product-based or people-based or place-based, but they believe that these companies are performing materially better than their competitors in that same industry and are taking leadership stances in terms of what they should be doing to help their employees or their supply chain. And they're very active in terms of their proxy voting, as well as their shareholder engagement with these management teams. In contrast, Generation, which is an active management strategy focused on public equities, they're more focused on the company's core product, as well as process-based impact. It's largely focused on climate change and environmental sustainability. And so there are companies, for example, Acuity and Sensata are focused on LED lighting, and where the sustainability of their product, the outcomes it's contributing is why they invested. And then the iShares ESG ETF, this is the one that I was involved in creating. You know, again, like, is Microsoft an impact company? To a lot of folks, the answer is no. But I think the reason they're included in this has to do with, you know, how Microsoft manages its ESG you know, management issues compared to its peers. And, you know, it incorporates a lot of exclusionary screening, like no alcohol companies, no tobacco, no oil and gas. These screens tend to be based on revenue. So like any company which drives more than 20% of their revenues from the oil and gas industry can't be in here. Okay, so you're taking out entire industries. A lot of the transportation sector, leisure sector, they're also taken out of here. And so these funds tend to have pretty strong overweights to the technology sector, which don't have those kinds of issues. But obviously Facebook and Google right now with antitrust questions bring on a whole other kind of set of ESG considerations that I think these types of funds are going to have to really consider what their policy and stance is going forward. In real assets, as I mentioned, you know, real assets can include real estate. It can also include farms, natural resources, bridges. They have a few different strategies, but their real estate strategy focuses on communities in the UK where they can build or develop assets that foster the community there. So the Huxton is a well-known brand of a hotel that was specifically put in a neighborhood that you know was not a high discretionary income neighborhood, but they choose to locate it there and put a nice hotel there. They specifically employed people, hired people from the community, and have really showed measurable change in the community due to their efforts with the hotel and their hiring practices. Turner Impact Capital, they have a few different strategies, all focused on real estate. One on residential real estate, focusing on you know, building communities of homes and apartments in areas that are lower income, but really paying a lot of attention to the needs of the community in terms of being close to transportation and schools. They also, the Turner Agassiz Charter School Facilities Fund specifically focuses on buying and leasing buildings for charter schools. So it's really the use case of the real estate. They have another strategy focused on hospitals and senior living. Moringa is focused on, through their investments in land and farmland, really improving damaged land and by utilizing more sustainable farming and agricultural practices, as well as, you know, by generating carbon credits. That's another piece of their business here. So Texpel is a coconut water and citrus company. Their orchards actually are specifically bought in areas to improve degraded land, and their entire processing facility was all built with particular sustainability practices in mind. Okay, so we got through the core asset classes there. And I now want to turn a little bit of attention to who are the investors in these funds. Because at the end of the day, if you look at the supply chain of the investment industry, it starts with the asset owners, individuals, endowments, foundations, pensions, sovereign wealth funds, insurance companies. So of those segments, where is this money coming from? And you see here from this study, the change from 2014 to 2018, which by the way is a lot of growth. But you're seeing that the mix has also changed, where banks and DFIs, used to be 16%, now they're 48%. Interestingly, and notably, they also have a lot of capital. Like those are big investors. Banks also represent a lot of retail investors. So underlying that are individuals. Pension funds have remained somewhat similar, but it's an interesting segment in that it's just such a huge segment, one of the largest, allocators there. Like a lot of big private equity and venture funds, they have pension investors. But if you were to look at, and I couldn't find the data, so unfortunately some of this is anecdotal, but the percent of pension funds actually doing this is very low, right? So that's the thing to keep in mind. In contrast, foundations, wow, why is it such a small sliver? It's actually because foundations are a very small piece of the larger, like who are investors and where's the money coming from. There are many more foundations as a percentage of foundations who are making impact investments, many, many more. They are far ahead of pension funds, but they're just a smaller piece of the pie. We see retail investors here. The other one that's I think really important is family offices and high net worth investors. Again, I think they're actually the leaders in this space, but they're not the biggest pool. So I think that if impact investing is going to grow, we need it to grow with the banks and the pensions and the insurance companies and the sovereign wealth funds, if it's ever going to be enough of our financial system to really make a difference. And so as these funds that I talked about are thinking about how to grow their firms, and as you all are thinking about how you want to make an impact with your career and where's the field going, pay attention to where the puck's going, as well as where it's not going, but it needs to go, in order for this to add up to anything at all. And we'll talk about careers in a second, but just keep that in mind. I also just wanted to show you some data too from the recent GIN survey around why are people doing it, the motivations. And you'll see that it aligns with what I just shared with you. The biggest reasons are it's central to their mission, they have a commitment to be a responsible investor, and it's an efficient way to meet our impact goals, which means they have impact goals. The folks who sign up for that are family offices, foundations. You're not going to find an insurance company necessarily. It's very rare. They exist, and I have one example for you, but it's rare. And so again, the about halfway down, you see we are responding to client demand. That's where you get the asset managers and the broader firms are doing it because their clients are just demanding it. So this is, I think, a really important thing to focus on is the motivations, again, as you're trying to figure out where in this ecosystem do you want to build your career. So let's talk about this. There's asset owners that I mentioned, and there are folks who do what I call them the 100% club. They've decided that all of their dollars need to have an impact. And then there are those who have to carve out, which is saying of our $10 billion endowment, $1 billion is going to be this. Or a third one, sorry, there's a bullet point missing here, but considered in all investments. That's a little more of like the ESG. We consider it all, but we're carving it out. So foundations, which have been a leader in the space like Kellogg and Ford and MacArthur, for example, yes, they're leaders with a lot of money, but no, their entire endowment is not focused on this. And I hope that will one day change. And then the investment managers are the funds we just talked about. And there are pure plays like Impact Engine, SJF, Calvert, many of the ones I spoke to you. But also the greatest growth here is also in traditional investment managers is offering impact funds. So I mentioned TPG. Bain is also doing this, KKR, you name it. And finally, advisors and intermediaries. So similarly, there are pure plays like Align, Impact, Flat World Partners are two examples where they're advising the asset owners on how to do this. But it's all focused on impact versus traditional firms have carved out a specific focus on this, whether it's Goldman acquiring Imprint so they can offer this or Morgan Stanley Sustainable Finance Unit. Allie, will you pause it for a second? Okay, so with that in mind, let's go through some examples. The Heron Foundation, and I won't read what's here, you can do that yourself, but I think the important thing to know is that they're focused on helping people in communities help themselves out of poverty. And they have been a huge leader in this field in that really one of the first to start exploring impact investing in ESG. They moved from 40% to 100%. And in 2016, they're really one of the first notable large foundations to move 100% of their portfolio to mission aligned. There are examples here. I've actually covered a number of these examples before, but they invest in impact funds that, again, as closely aligned as they are to their mission. That's where they tend to focus. The Kellogg Foundation, also a foundation focused on child welfare. They have certain a place-based focus as well in terms of certain states where they're focused on. Now, they were one of the first proponents of double bottom line investing foundations, which were not like Heron, not just their PRIs. PRIs are, a foundation, 5% of their assets they have to give away each year. PRIs are when you make an investment through the 5%. So instead of it being philanthropic, it's an investment, but if it's closely tied to your mission, it can count towards it. So lots of foundations do that, but Kellogg and Heron were really one of the first which said, no, we're doing this out of our endowment, our 95%, where all that capital is. And that's where they've been a leader. So they carve it out. It was $100 million initially. It's since increased. And this is in addition to their PRIs. So some examples here, like Rethink we mentioned. They also make direct investments, some examples here in some banks and CDFIs. I'll cover a couple families now. So the Rockefeller family, which has its own ties to the University of Chicago, the money was made from the oil and gas industry. And eventually there was a certain generation that came along that, didn't, wanted to actually use their assets to actually help fight climate change. And kind of felt a responsibility that we're actually maybe potentially part of kind of the problem. Now let's use our assets to help solve it. There's a lot of case studies about them out there, so you can read more online. Actually, even Kellogg and Heron, if you Google it, you will find interesting, deeper research on it that you may enjoy. So they, again, like a lot of folks, they started out with 10% of it focused on impact investing with a focus specifically on sustainability. And over time, they've moved a lot more. Again, this is beyond PRIs. Some of this is family capital, some of it's their foundation. And compared to Heron and Kellogg, this is exclusively focused on sustainability, and you can see some of the examples here. Blue Haven Initiative is the family office for Liesl Pritzker Simmons and Ian Simmons. They're very public and transparent about what they do. They wanted to make the case that you can have an entire family office portfolio focused on impact, everything from where your cash is invested to your venture investing to your private debt, fixed income, everything. That this should not be only for venture capital. Huge leaders in proving that to folks, and that's why they're very public about what they do. They also, similar to Kellogg and Rockefeller, they make fund investments, which you see a number of them here, as well as direct investments. And there they have a place-based focus on Africa, and that's where they tend to focus their direct investments. Have to have an endowment example here, mostly because most endowments are not doing this. I would say they're one of the investor types that are lagging. And if, my opinion is that it doesn't really make sense. I think they're just like foundations and that they're mission driven and aligned and they should be doing this, but they haven't. So Hampshire is one it started out with a divestment movement from South Africa. Again, one of the real key milestones for this entire space. Then they moved to divest from weapons manufacturers, eventually added ESG criteria, became really well known in terms of their actually voting their proxies in a way to that are aligned with the college's mission. Eventually divested from fossil fuels. Endowment divesting from fossil fuels has been a pretty big movement. And now, it's connected to their commitment around the carbon neutrality of their actual facilities and operations. So you can see that there's a pretty significant environmental focus to some of the investments they've made as well. Now, Westpath, going back to that original, where this all came from, was religious investors. So this is the pension behind the Methodist Church. And, you know, they've been a leader, not just with the exclusionary screening, but really exercising their power. It's a fairly, you know, they have over $23 billion under management. That's a lot. And so to vote your proxies that way and push companies, influence them to change their practices based on it, is pretty powerful. And then they also have a social purpose lending vehicle focused on lending to underserved communities. They're actually based here outside of Chicago, and you know, really, I think on the cutting edge of always trying to think through even deeper how they can do more and more with their capital. And finally, I mentioned some insurance companies do this. So Prudential, you know, it started with affordable housing investing. Eventually, it led to small business lending, and you know, they're now full-on impact investors. There's a place-based focus, but there's also a catalytic component, and they back a lot of new funds and try to like really shape the ecosystem. So I just wanted to provide some examples, because if you're going to go into this field, you need to understand the why, right? The motivations, but you also have to understand the particular constraints and preferences of each investor. So I went through them quickly, but I think you probably already, though, could see the differences in terms of what a Prudential might want to do versus a Westpath. And so as you're you know, trying to get a job at a firm or start your own, I hope actually your own impact investment firm, you have to think about what problem are you solving, both at where your dollars are going, back to the SDGs, right, the 5 Ps, but also what problem are you solving for your clients and your investors and what they're trying to do. And that takes time to get to know. So I think you should be thinking about that from the very beginning. So all this is to say that there's a huge opportunity. We're in the very early innings of impact investing becoming a really large portion of the asset management industry, and ESG really becoming the gold standard for what it means to be an investor. And what do we need to get there? This GIN survey, sorry, I realized the citation was cut off, but this is from the Global Impact Investing Network's survey, is that the professionals with relevant skill sets is still one of the biggest challenges. So what does relevant mean? It means that you need to have the technical expertise. You need to be an investor. You need to know what it means and have the skills to be a good investor, not just an investor, be a damn good one. And you have to really understand these social environmental problems, why they exist, why there are these market failures, how does this intersect with policy decisions? Where are there, you know, you need both of those lenses to come together to be able to figure out what are the commercial solutions that are investable for this issue. And too often we meet people who really understand the problems, but they don't have that acumen around what makes for a good investable commercial solution to it. And vice versa, lots of great investors, and they're investing in things, they're calling it impact, and they have not gone through the exercise of really understanding, evaluating, and managing the impact. That is what we call impact washing, and it is a big problem. There are a bunch of other gaps here that folks are saying are challenges. And I think with the right training, there's an opportunity, again, to start new firms, to go work at firms and make them better to solve for this. And so how do you do it? I think that the other thing is that, you know, to get in the impact investing field, it doesn't mean everyone's an investor. Not everyone should be an investor. It's like any other industry. There's various, you know, roles and functional skill sets that are needed. And so you got to reflect really internally on what are you good at and what do you want to do? And don't just, the idea of impact investing doesn't mean you need to go be the financial professional. You can, you know, don't fall into that fallacy there. So, you know, everyone kind of wants to be the quarterback and the CIO or portfolio manager. You know, you start as an analyst or associate, and every great, you know, partner or CIO has spent a lot of years really learning the basics of how do you source this? You know, how do you diligence companies? How do you really understand what makes for a good investment before you can step into the seat of making the decision and managing it? There's also operating partners and folks who come from an operational background. Maybe they're entrepreneurs. Maybe they just worked at and had managerial senior roles at big companies. That's really, really important in private equity and venture, to have folks who run the company to help inform the decisions and help those companies. There's also advisors and consulting firms, which are advising and consulting asset owners as well as investment firms on how to do this, how to make impact investments. I think that's actually the biggest gap. They're the biggest gatekeeper. When I'm talking to more and more asset owners who want to make impact investments and aren't, the most common reason is that their advisor doesn't know how. And they're often a little bit, they're posturing. They're saying they shouldn't because it's not a good idea, but really it's that they don't know how. So again, if we get really trained professionals in the advisory intermediary capacity, this whole space will continue to grow. Finally, again, all these are non-investment specific roles, business development, marketing, investor relations, so important, even more important in impact investing, because there's this customization to this field that is really important, as well as just being, we need strong CFOs and COOs to build these firms. And finally, there's a huge capacity need around field building. Organizations like GIN or SOCAP or SIF, Impact Management Project, where you're helping to develop research and best practices and marketing to help the field grow, to support all these other types of groups. And so back to the very beginning, my journey, and I hope you talk to many other impact investors, you'll hear the same thing. It's not a straight shot. In fact, I think if it was, you wouldn't end up being as skilled. I think you need to wind to have perspective. If you go straight into impact investing, you get to the good stuff right away. It's what you want to do. You don't have to prove your commitment or skill in the area down the road. You did it from the beginning, but there is a lot of demand. It's very competitive. It's very hard to get in. And I will also say that a lot of the impact investment firms are still a bit smaller. And so they're not necessarily always the best training ground in terms of those technical skills. Some are, like there are, firms that I think can do a great job of that. But the more traditional, banking private equity approach before will give you a certain kind of training that's more, it's standard. They expect that for an analyst or an associate, that they're going to have to train them. And it's just honestly going to require a lot of hustle to do it. It's not like career services has a long list of impact investing jobs, and you're just going to have to network and be really resourceful to connect with the right folks and kind of prove that you have some value to bring. Now going, traditional investing first, the hustle's not as needed, like there are more jobs. You have to still be committed to that process, but I will just say that there are more jobs to choose from, and you will develop, again, a lot of those jobs coming out of business school are really designed to train you in a very structured way, so that then if you go into impact investing, you can say like, well, I know how to do this. I did 2 years of banking. I did 2 years of private equity. On the other hand, people might not be convinced that you have a commitment or really any value to add from the impact side. Because I can tell you that I have lots of job candidates who bring all those finance skills, but they don't even say it in their cover letter. There's nothing in their resume that answers my question of how do I think you even understand social issues and the solutions to them. So that's what you're going to have to prove. And it's less entrepreneurial a lot of times, unless, and I've said this throughout, like go to firms that are maybe not doing it yet, and you go be the entrepreneur and the change maker and say, we need to be thinking about impact investing. We need to be thinking about ESG, and you go be the entrepreneur there. That's how every firm, whether it's TPG or KKR, these big firms that did it, or even, Prudential or, Heron, at the asset owner or GP level, it's a person who said, this makes sense. There's a business case for this that's aligned, and we need to do it and pave that path. So that's kind of an in-between of these two. And I think just actually, there's no right or wrong. It's about what's a good fit for you, and also casting a wide net, knowing that it's a nascent field, and you need some luck and some tailwinds in your favor to get where you need to go. So that is all we have here for today. I hope you guys all enjoyed it, and I know at the Rustandy Center we have a number of other programs to dive deeper into a particular area of impact investing that you're interested in, or a specific role. We have the Mint competition, we have the impact investing course, we have SMBC, a number of other things. But hopefully this provides just a good overview to help you understand whether this is something you want to spend more time on, both within the curriculum or extracurricularly. I also hold office hours fairly regularly, and I'm happy to chat with anyone who has specific questions about impact investing and careers in it. So thank you.